You don't need external shocks like wars or oil crises to explain economic cycles. The system generates them all by itself, endogenously, from within. The same internal structure of investment, delays, and human perception creates short-term business cycles, medium-term investment booms, and even the massive 50-year-long waves of growth and depression.
This gives us a totally different way to look at something like the Great Depression. From this point of view, it wasn't some random catastrophe caused by a stock market crash. No, it was the predictable bottom of a long wave, the inevitable correction after decades of overbuilding and overinvestment. The collapse wasn't a bug in the system. It was a feature of its structure. This quote from a former head of the Royal Economic Society just nails the whole philosophy. We ought to value powers of observation more highly than powers of abstraction. In other words, start with reality. Look at how things actually work first, and build your understanding up from there.
And this all leads to the most important takeaway here. The goal of this kind of thinking isn't about having a crystal ball to predict the future. That's a fool's game. The real power is in understanding the underlying structures that create that future. Because once you can actually see the machine, you can start to redesign it for better results.